It's anything but easy. And I think a lot of people wanted an easier start to the year. It looks like we're just not going to get it. I think we're continuing a big theme that we were starting to digest back in December, which is the more aggressive actions from the Federal Reserve than what equity investors would prefer. And, one thing we see over time, Brian, it's not just a function of the last few months, but over time, when the 10-year yield is rising, expensive stocks tend to underperform cheap stocks. That is exactly what's going on right now. Tech is really the home to some of your most expensive valuations in the market, as you pointed out earlier. But financials and energy, those two sectors that you mentioned that are doing so well to start the year, that's what's really populating the bucket of cheapest stocks in the market right now. So if you look at it just by the numbers, the price action is actually very, very rational. Throw in the fact that growth has been expensive if you look at the asset manager data on the CFT futures positioning, and you've got a recipe for a fierce unwind, and that's simply what we're going through right now. It's just a repricing.
That's kind of what we tried to highlight with those names. And obviously, Lori, those were extreme. I mean, not the companies, but those valuations. But is that a lesson right now to our viewers and your clients that if you own these really high growth, high valuation names, just be careful?
I think that's right. And I think the issue here, right, is fundamentals don't always drive the price action. And equity investors hate it when I say things like that. But that is simply the truth. If you think about fundamentals in terms of the specific companies themselves, right, there are a lot of great businesses that are going to get caught up in this repricing. And as an investor, I think you have to decide, are you more near-term focused, more intermediate-term focused, where this repricing will create some pain, or are you longer-term focused? If you're really a longer-term investor, you may be able to ride this out and pick up some bargains. But if you do care about the next few months, this is going to be an area of pain for perhaps a bit longer.
It's not just your clients or equity investors. TV viewers also hate it when you say stuff like that as well. But it is true, Lori, and sometimes you got to have the hard truth. There's nothing wrong with that. All right, so if we're in this environment of rate shifting and the Fed trying to unwind, I don't know how they're going to do it, but try to unwind an $8+ trillion balance sheet, what do we invest in now?
Well, look, I think some of the areas of the market that have been working this year, financials and energy, are still very inexpensive, and there is still value there. As long as that valuation opportunity is still in place, those are good areas to look at. I mean, I think other areas, if you're just looking from a strict valuation perspective, we've been getting a lot of questions on things like consumer staples, which has been out of favor and hated for quite a long time. I'm neutral there, but the valuations admittedly are pretty tempting. And another cyclical sector that looks interesting on a valuation side right now is materials. Materials is also interesting if supply chain pressures ease later this year, as a lot of investors have expected. So there are bits and pieces that you can look at, but frankly, Brian, they just may be bits and pieces of the market that investors haven't wanted to look at for a number of years.
Yeah, what are those best parts, Lori? Give us some actionable advice to start our 2022.
Well, look, I would say in addition to all the sectors we just talked about, small caps are deeply undervalued relative to large cap. And they didn't have a great day yesterday, but they have had some nice moves over the past couple of weeks on days where the market has gotten more confidence that we're going to get through the Omicron variant without any real damage to the economy. So if you're feeling pretty good about the economic backdrop, and I personally think that we will come out of this Omicron episode with a healthy economy intact, that's another area that's frankly been ignored for the past few years, that you really can find some interesting valuation opportunity, including in things like financials and consumer stocks.
Are you a believer then in the financials? We've seen them tick up as rates have ticked up, but we all know, Lori, there's no way that interest rates are going to keep rising at this pace. If so, we'd have a 4%, 10-year yield by mid-March. So this was probably the shift. Can we still find some value in banks and financials?
So look, the hard truth with financials, and we'll talk about another hard truth here, is that they are not going to outperform if the 10-year yield is not rising. That is simply how they trade. Our rate strategy team thinks the 10-year yield can move up to about 2.2% by later this year. So there's still some runway here, but we do tell people with financials, we do think it's a trade, and we do expect by mid-year we're going to see some of the valuation opportunity pulled out of the financials. We'll probably be getting closer to the end of the increase in the 10-year yield if our rate strategy team is right. And then that might actually be the time to pivot back towards some of these growth and tech stocks that are getting so beaten up right now. So I wouldn't get too comfortable there for a multi-year period, but I think we'll have a nice trade there between now and mid-year.